Good morning. It's Wednesday, the 24th of July, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai usually, but now in transit. A fresh heads up, I'm traveling for a conference and thus will be intermittent or have short episodes for the next few days.
This is the Co Report with Govindraj Ethiraj.
So the big take and the big expectation from a union budget exercise is when you feel your wallet feels heavier for now or your hopes are raised for the future. Hopes could include getting a job, better jobs, health, education for oneself and the family, and of course a house that one can call one's own. Measuring any government's performance, including through the instrument of the Union Budget 2024 that was presented yesterday, should ideally be done through these lenses. Macroeconomic policy must eventually serve these interests. Greater competition induces better products and services. A stable and low-intensity tax regime ensures businesses, small and big, focus on creating value and building enterprises rather than battling it out in tax courts. And infrastructure, physical and social, must grow to support this. In this context, there's nothing so major in this budget that can transform our lives from tomorrow, but equally, nor should one expect such moves. As always, look for the several small steps forward and maybe a few backward and see where it adds up. On the fiscal side, the government has said it will spend a record 11.11 trillion rupees, that's about $133 billion on infrastructure in the financial year ending March 25, which obviously in turn will support growth and create more jobs as it has done in the past. The spending plan, by the way, is unchanged from the interim budget that was presented in February before the national elections. The infra push will obviously continue to spur growth as it has before, though the question, of course, which is usually left unasked is what about private investment, which has been lagging, which always needs not just incentives, but clarity in policy and laws. So let's pick one example. We talked of the angel tax or Section 56 of the Income Tax Act, which taxes investments into companies by classifying them as income, a situation that quite surely does not exist anywhere else in the world. And India had it, and it flourished, and thousands of companies were terrorized for the best part of maybe 12 years. Now, we said yesterday that the angel tax should be thrown out and not just made more complex or more laws brought into it. Thankfully, the government has done that. This also tells you that it is easy to pass laws, but getting them out takes years and mind-numbing effort. Angel tax is a case, by the way, where the finance minister in successive budgets has already said that they were doing away with it. Even now, I would wait to see if the whole section goes and does not crop up or reappear in another part of the Income Tax Act under a new name. Speaking of throwing out taxes, another tax that should have gone is the tax collected at source or TCS on overseas spends, including in credit cards. The idea being presumably to curtail overseas expenditure and thus save precious dollars. But it's not clear how this was helping, and clearly this was creating or set to create a mountain of paperwork and work for everyone. Earlier, the tax could only be claimed back at the end of the year. So the good news now is that the government is allowing your employer to adjust the TCS against the tax deducted at source that you pay from your salary. So for example, if you incurred rupees 100 as TCS, particularly on official expenditure, and your TDS from your salary is 500 rupees for that month, then your employer will only pay 400 rupees as TDS to the government and the rest comes back to your salary. So I don't know if this will work as advertised, but this is how it looks like. And I'm hoping it'll obviously become simpler, but I very much doubt. And like I said, these are illustrations, whether it's angel tax or TCS, of laws that are perhaps unnecessary and not in keeping with the rest of advancements in tracking and monitoring of fund flows and flows in general, and something that can clearly be done away with. At a very broad level, I would surely have some quibbles, but the undertone I'm seeing with the economic survey and now the union budget is that the establishment seems to be listening a little more than before. Perhaps that reflects the changed political mix with the BJP no longer in absolute majority. Perhaps it's a realization and evolution that consultation and listening is critical to policy making. The outcome is obviously welcome and positive. That the government was going to tinker now with long and short-term capital gains for sale of assets was quite evident, including from the steady briefings to various economists who in turn put out their assessments and prepared the ground. Nothing wrong with that unless you were the economist who did not get that briefing. I would rather see the imposition of taxes, including higher securities transaction tax and capital gains, as moves to cool an overheated market and, of course, encourage long-term investments. The increase in short-term capital gains on equities from 15 to 20% is thus a good move. Similarly, long-term capital gains, if you sell beyond a year, have been increased from 10 to 12.5%. But the short term is important. At least the system is saying that keep your money invested in stocks for longer periods and surely more than a year, and therefore you will benefit, and so will everyone else, including the real purpose or the original purpose, which is capital creation. My personal sense is that such taxes also keep changing and nothing is permanent. Tomorrow, if for some reason interest in equity markets begins to dwindle, then the government could be incentivized to lower them, or for some other reason of rationalization. We also touched on jobs and aspiration. There are some new ideas here, including to provide incentives to individuals who join the workforce and to companies who create these jobs. A nationwide internship program to provide internship to 10 million youth in the next 5 years with the top 100 companies is a good idea. The cost of the internship, including stipends, is to be borne by the companies from their CSR funds. Put differently, the government is expanding the ambit of your CSR budget or corporate social responsibility budget, which many companies struggle to put good use to. On the other hand, managing a flow of interns into companies takes effort and additional infrastructure, so I would like to see how companies react once they finish giving their wholesome praise to the budget, as they usually do. On the other hand, I also subscribe to the idea of internships, and I can see many companies doing it already and many colleges directing their students to spend time in organizations in the last few years. A CV with an internship looks stronger than one without. The government is also incentivizing companies and manufacturing organizations by providing a month's wage to employees entering the workforce in all formal sectors. The rub, of course, is formal because that only represents perhaps 7% of the workforce, but then it's a start. The scheme would see a month's salary of up to about 15,000 rupees in 3 installments to first-time employees as registered with the Employee Provident Fund Organization, or EPFO, which is essentially the government's proxy for also measuring formal job creation. Now, the question I could pose is, how does a manufacturing company see it from their perspective? Perhaps it reduces the wage bill potentially at start, but is that enough to expand capacity alone? I'm not sure, but we will explore this in coming days as it does merit discussion, because steps like this are important and perhaps need to be brought in or dovetail with other steps which we perhaps even don't know about right now. A lot of other actions, including around cutting import duties, only benefit us and make manufacturing for exports more competitive, or are in response to not so well thought through actions earlier, like the reduction of customs duties on gold, which happened in the budget this year. It was evident that the increase in customs duties on gold had dramatically increased smuggling, as it has always happened for decades, and there was no new insight that indicated otherwise. So by reversing it, it seems like a great step, but then we shouldn't have increased it in the first place. In general, and as I sum up, we need to lower import tariffs to become more competitive. There is no way around it, and we can't dump all our problems on the central government and budgets like this as well. Just saying. The stock markets are chewing on the government's proposals. Stocks ended a seesaw session lower on Tuesday as the jump in consumer stocks on the promise of higher rural spending from the budget couldn't help the market fully pull back from a slide after a hike in taxes on equity trading, which is capital gains, Reuters reported. The NSE Nifty ended lower about 0.1% at 24,479. The BSE Sensex was marginally down at 80,429. The day itself was predictably volatile. So while the market seemed to have taken in the announcement of a higher capital gains tax somewhat bravely, the real impact of that move, my sense is, may take a few more days to play out. Consumer stocks like HUL did well, but the biggest drag was Larsen & Toubro, which fell 3.1% after the government did not increase the amount it planned to spend on infrastructure. The spend levels are high, of course, but the markets expected even higher. Other infrastructure stocks also fell. Realty stocks reversed early gains and they fell almost 2.5%, says Reuters, after the government removed an indexation effect on property sales, which essentially means a higher sales tax. And the rupee fell to a record low. Meanwhile, the rupee slipped to a record low on Tuesday following the government's moves to raise taxes. The rupee ended slightly lower than the US dollar at 83 rupees 68 paise, its weakest ever closing, after having slipped to a record low of 83 rupees 71 paise earlier in the session. Broadly, as an outlook for markets and companies, it does not seem like the budget changes anything dramatically if you were to go by what was expected from companies a few months ago or even earlier in the year. The growth drivers for most companies continue to be in place or were in place before the budget, and that will continue to be the case as it appears now. I'm now joined by Uday Ved, partner at KNAV based in Mumbai. Uday is a veteran in tax in general and direct tax in specific. and I've had the pleasure of speaking to him many times on occasions like this. Uday, thank you so much for joining me. So, your first very broad takeaway from the union budget in terms of those 2 or 3 things that stood out for you?
The first part is this is the seventh consecutive budget by the same finance minister. And there is clearly a continuity and stability in the tax policy. So there is a path which has been laid down since 2015 and it continues. So that's, I think, a very good part. And then what investors, including foreign investors, want is a stability in the path and also bringing certainty on tax position. So I think one can rely on that. That's one part. And we have seen that consecutive falling tax rates, moderate tax rates. And this time the effort has been more on rationalization, easing tax administration, reducing tax litigation. So we have Vivad to Ishwat scheme, commissioner appeal, tax litigation. So all those good kind of measures in terms of the entire continuity, stability, etc. And the ease of administration. The finance minister also made one very interesting statement that she's looking at an overall, the entire comprehensive overall of the Income Tax Act 1961 in 6 months' time. So I also like that there is always a time limit which is being given, which was never the case, I think, many years back. And you've seen that in 6 months, on the floor of parliament, you are saying you will make a comprehensive review. Now, whether that review will be changing the entire Income Tax Act itself and bringing a new direct tax code, or it will be changed to the existing Income Tax Act, that needs to be seen. So that is another good part. And things have changed to align, say, cross-border mergers, reverse flip, which are happening. Those are not factors. So some of those changes may come. Some of the changes on anti-tax avoidance, GAR, general anti-avoidance, have already come in the picture. So those kind of changes will come. The rationalization which has happened, and 2 or 3 things she has picked up this time, is this entire, rationalization or bringing together the entire capital gains tax regime, which is, I think, a major change which has come in. And you've seen that tinkering over last so many years, decades, to keep on changing different rates for residents, different rates for non-resident and foreign companies, then listed securities, non-listed securities, immovable properties, different rates. And at times, even people like us lose track of what it is, right? Then the number of years, whether it's a 12 months is a long term or a 24 or a 36 or 24. In fact, there are some which are still 36, right? Today also. So what she's tried to do is to rationalize the entire. First of all, the difference between resident and non-resident is gone. So whereas a non-resident had a favorable tax of 10% on long-term gain, the resident used to pay 20%. That has been merged to 12.5%. Now, whether it is a listed securities or non-listed securities or any other non-financial asset, as an example, even immovable property, which is being sold, right? Even that, everything will come under the 12.5% rate, which is one good part. So you don't need to worry about it. If it is, then the only 2 periods are specified. For listed securities, still the rate time limit is 12 months. For non-listed, it is now 24 months. Or any other property, it is non-financial asset, it is 24 months. And if it is a short term, it is within the 24 months, then it becomes a short term asset where the tax rate is 20%. So entire 20, 30, 10, all has been, rationalized at 12.5% for long term, 20% for short term. Only one change which has been made there is, and which is an interesting one, is that there was an indexation benefit possible for at least for sale of immovable property. That has been done away with to say our 20% rate itself has become 12.5%.
Right. So you don't deserve a further sales concession.
They don't deserve, or even for the unlisted shares, if it means. I think there's some gain, some loss, but simple 12.5, 20, no change. Everybody resident, non-resident at par. And the only 2 periods are 12 months and 24 months. So the major rationalization on the capital gains regime has been done. The other thing is entire TDS rationalization which has happened. Different rates have been all merged into one part. In 5% limit has been put to say 2% in many situations. So a lot of rationalization on this has happened.
Does that benefit the individual in any way, this TDS rationalization?
Yes, to an extent, yes, because a lot of things where there was a 5% tax, it has become 2%. In many situations, there was either 10% tax, 5, 2. So that definitely it will benefit. It is naturally, as far as employees are concerned, they are still governed under Section 192 on the normal TDS, which will happen for them. But other than that, it does benefit. It becomes easier from a deductor perspective also, right? Withholding tax to be paid when they deduct it becomes much more easier.
And quickly on personal income tax, Uday, I mean, obviously the limit has now increased. So how are you seeing it?
So that's more change at the lower level, little bit tinkering. I would believe that there was an expectation in terms of what could have been done to say that, whether the exemption limit could have been increased, the tax rates could have been liberalized. For the new regime up to 15 lakh, little bit tinkering has been done. But I would believe maybe that is left for the larger 6 months later, what may come through, right? And just look at it from the government perspective, that they just come to a power, right, in a month back, and then within 1 month there is a budget. So it's always up to a point that can be done. So maybe that on an individual front, not much change except little bit tinkering, and said that there is a tax saving of 17,500 rupees. That's what the finance minister said. So yes.
Last question, Uday. Any disappointment, any areas where you were expecting something that didn't happen or you felt there could have been more attention on?
On a larger front, on a international or a cross-border for large corporates, there is this entire BEPS regime and, what is called Pillar 1 and Pillar 2.
Pillar 2, yeah. We were supposed to see Pillar 2 this time, yeah.
So we were supposed to see that. To an extent, little bit tinkering has been done. So like e-commerce, the equalization levy has been removed. So that actually a Pillar 1 part of it. Pillar 2 could have come because I think India is signed a signatory to that. But maybe again that is left possibly to the to the larger overall. And I think in 7 months' time, it's not that far. In February, we could see that. And the good part is, I think hopefully there will be consultation, and a lot of inputs have been taken into consideration. The Pillar 1, Pillar 2 could have been one situation on a larger basis which could have come.
And this affects only large companies who were profit shifting between nationalities.
Not only very large companies, interestingly, Govind, even the mid-sized companies, the turnover of $750 million, which is 5,000 crores. Now today comes, there will be a lot of Indian companies going global, which 5,000 crores is not that big amount. So it will impact mid-sized companies also, but yes.
So, but the direction is that you can't profit shift. You can't keep looking for new jurisdictions.
That's the whole purpose. The entire Pillar 2 says that there should be a minimum tax of 15%. So that you don't use a location only for the purpose of tax benefit.
Right, Uday, we've run out of time. Thank you so much for joining me.
Thank you. Thanks for having me.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.